Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com.
Yes, so hello and welcome to our next instalment of Nucleus Insights, which we've entitled The State of the Nation, as a bit of a reply and a bit of overview to the March quarter national reports that came out. With no further ado, we'll jump into it. So we've got with us here today the full complement, the full team in our new studio in Collins Street. And we're looking forward to putting together some presentations here. Now, just keep in mind there is a little bit of construction going on just north of us, so we'll try and keep that down with the levels as well. So agenda today we'll be looking at is the quarterly results. We'll then be looking into a GDP in focus, posing the question of potentially the Australian workers missing out, moving into borrowing powered consumption, and then wrapping it up and looking forward in future headwinds. And then, as always, we'll be covering off on the impacts for investment in what we do every day here at Nucleus Wealth. So let's jump into it. Welcome, Leith. How are you going?
G'day, Tim. Hello, everybody.
Had a busy evening?
Yeah, pretty busy. It's always busy this time of year when the national accounts comes out. It's my favourite time of the quarter. I'm a bit of a nerd. So, yeah, I quite enjoy this time.
Excellent. Well, you've put together a fantastic collection of graphs, and just a quick note for those that are listening in on the podcast that the graph pack will be available as PDF on the Nucleus website under the webcast or the webinar post for today as well. So feel free to check that out. Sure thing. Okay, so looking into GDP. So quarter one GDP, what have you got for us, Leith?
Yeah, look, it was a pretty strong quarter superficially of economic growth. The economy grew by 1% in the March quarter and by 3.1% year on year, which is pretty strong and I guess slightly above trend. In trend terms, which is actually the figure you really should look at because that smooths out the quarter to quarter volatility, and it's the ABS's preferred measure. The economy grew by 0.7% over the quarter and by 2.8% year on year. And the chart that's in front of you shows the annual GDP growth in both real and nominal terms. Going all the way back to basically the early 90s recession, and you can see that the annual growth has picked up. And however, the dollar value of GDP, which is called nominal GDP, has actually fallen quite significantly recently, although it did bounce a little bit in the latest quarter. and it's currently tracking about 4%, which is in year-on-year terms, which is well down on the post-1990 average of almost 6%. So that has implications for government revenue, etc.
Okay, sure thing. Damien there?
Yeah, I think it's worth just noting as well, isn't it, Leith, that nominal is what we all live. Like, you sort of look at some of those graphs and you notice that you look back, I think certainly for real GDP growth, say during the 2000s, you sort of see a bit of a tick up, but nowhere near the size of the boom that we sort of experienced in terms of the real. Whereas I feel as if the nominal captures that a lot better, and you see that when the financial crisis hit, the real GDP was this tiny, a bit of a fall down, whereas the nominal GDP was a massive drop in terms of the growth rate there.
Yeah, absolutely. The nominal GDP's dictated to a large extent by the rise and fall in commodity prices and the terms of trade, and national income. So when commodity prices rise, terms of trade rises, national income rises, the nominal GDP rises, and vice versa. If we flick across the next chart, this actually shows the breakdown of the growth drivers over the March quarter in seasonally adjusted terms. And as you can see, there was pretty much broad-based growth across pretty much every component. So we had consumption rise, although not by that much. Investment rose by a bit. But inventories and net exports were net exports in particular, and government were the key drivers again. So yeah, it was pretty broad-based, which again is superficially good. But what it matters, and this gets back to a little bit to Damien's point. If you go to the next chart, this what I put here, I put the annual growth in final demand. Now, final demand is basically GDP without net export, so it's actually what's been spent in the economy, and it's a better gauge of the domestic economy's strength. And this has also picked up, and it was grew by 0.6% over the March quarter and by 3.2% year on year in both seasonally adjusted and trend terms. And as you can see, final demand's been driven by household consumption, which accounts for about half of it usually, and also a big pickup in public demand recently, and also a little bit of business investment, which kind of reverses a trend that we saw after the mining boom, whereby business investment subtracted from growth. Now it's starting to add, but it has been offset a bit by falling dwelling construction. So as the housing construction booms peaked, it's now falling, and now it's starting to subtract from growth. So superficially it's all okay, but the same old problems in the economy exist that we've had for a number of years.
Okay, sure.
I think it's probably worth noting as well that some of that GDP growth in terms of the big LNG exports that we've got going on, if they're owned by international companies, the big benefit for GDP was they came in here, spent billions and billions of dollars building things and employing Australian workers and things like that, and now they're finished. And the effect now on GDP is that they produce another unit in here and export it, which is good for GDP, and then the money comes in and goes straight back out to the foreign shareholder. They've still got lots of losses, so there's no tax benefit or no real tax revenue coming in for the governments, and so that's sort of, while it's certainly, I'm not arguing that it is part of GDP. I guess it's not part of GDP that really benefits the average Australian or even the average Australian business, as a lot of these are owned. And these are very meaningful projects in terms of the size of exports that's coming on because of these because of the ramp up of these projects.
And you can actually see that on Thursday we wrote an article in Macro Business looking at the WA economy, and WA's final demand actually fell in the March quarter, but although the quarterly annual national accounts don't provide state by state breakdown of GDP, we do know that net exports drove GDP. And most of those come from WA. So we've got this perverse situation whereby WA's GDP, if it was reported, would have boomed in the March quarter, but final demand actually went backwards, and it's all relates to the issues that Damien just spoke to. But personally, if you want a better gauge of what's going on in the actual economy and where people live and what they feel, you're better off looking at final demand because it excludes the net export impact.
Okay, sure thing. No problems. All right. And so now looking or focusing more into gross domestic products, so the GDP figures trending down.
Yeah, look, this is pretty much a continuation of the trend we've had for well over a decade, whereby the aggregate economy is looking okay. and the GDP is tracking okay. But when you actually break it down to the per person level, and this chart and the next one, which we'll put up, shows it in absolute startling detail. The growth in GDP per capita has been falling, and it's been falling for decades. So basically, the agri-economy is growing at a decent clip. A lot of that's because we're adding heaps and heaps and heaps of people. But per person, the growth has been trending down for a long time. And in fact, if we skip to the next chart, it shows it even more clearly. And what this shows, it's the very long-term trend of growth in GDP per capita. So basically annualised GDP growth over a decade and done in a rolling terms. And you can see that GDP per capita has actually fallen to the lowest level since the early 80s and early 90s recessions, when you smooth out. So basically, again, it's this problem whereby the agri-economy is going fine, but per person it's not travelling so well.
Okay, sure thing. And so then we'll jump across to just quickly on the domestic economy.
Yeah, look, this is a continuation of, I guess, the last point, except that we're looking at just final demand and a few other measures like final demand, which effectively measure the domestic economy without net exports. So the measures here are gross national expenditure, so that's basically expenditure in the economy, domestic final demand, which is pretty similar, as well as real national disposable income per capita. And what this shows is that despite a modest improvement recently, we've had virtually zero growth in all these indicators in per capita terms over the past 6 years. So that's effectively, or 5 or 6 years. So we've basically had, basically the per person lived experience has been treating water for 5 to 6 years, and individually in narrow material economic sense, we're not better off.
Yeah, sure. And I think obviously you guys you've made this very clear over the last many years, and it's starting to really come to the front in the political spectrum as well now.
Yeah, well, for goodness knows how long. It could be 5, 6 years, maybe 7. I'm not too sure. We've been talking about this lost decade.
Yep.
Been calling it the lost decade, and again it gets down to these per capita impacts, where we've argued that Australia's facing a lost decade, a bit like Japan did in the early 90s, or from the early 90s, whereby the agri-economy is going okay, but the per-person experience is actually treating water, and it is very noticeable in this data. And in fact, it's even a little bit more worrying when we skip ahead and we look at the breakdown of how the gains from economic growth are currently being distributed.
Yeah, okay, let's have a look at those.
So what I've done here is I've actually plotted the aggregate growth in business profits versus wages. And this comes from the wages and salaries data that precedes the national accounts. It comes out a few days before, but it does feed into the national accounts. And what you can see there is that that real wages have basically been treating water for years. And this isn't broken down per capita. This is in aggregate across the economy. So it accounts for the extra employees and extra people that have been added. And even despite that, aggregate real wages have basically treated water for about 5 years, where by contrast corporate profits have bounced quite strongly in recent times. And if you skip ahead to the next chart, a lot of the reason for the bounce in corporate profits is because the terms of trade, i.e. commodity prices, have rebound, and that's obviously boosted profits in the mining industry, as well as we had a bit of a bounce in net exports as well, so that means more volumes. So basically, we've got this situation whereby, again, net exports, bouncing commodity prices has juiced corporate profits, but unfortunately, workers aren't experiencing the gains.
I'll just add something there.
Yeah, sure, Dave. Fire away, mate.
It's David here. That divergence in mining has been driven, especially by the fact that we had this huge build out. Up until kind of 2011, it started to roll over, but the mining investment boom created all this huge new capacity. Then we had the bust and a lot of cost out. That is, a huge number of jobs were lost in mining and in oil and gas as they completed their projects. And then we had, the rebound in the terms of trade with the China stimulus, and so that kind of landed on these mining firms that had reduced their costs a great deal, and so their profits went through the roof. But they're actually contrary to the investment boom that preceded this, they're cutting costs into this profits boom, and that includes labour. So, there's owing to this kind of investment super cycle that preceded things. A lot of economists have anticipated greater investment and an uptick in wages coming out of the mining, the resumption of the mining boom in the terms of trade boom. But in fact, it's the opposite, where miners are still cutting costs and labour, not investing, looking to de-bottleneck, looking for productivity gains. And so this is one of the reasons why the terms of trade rebound and the mining profits rebound has actually resulted in falling real wages.
Yeah, okay.
Which is the first.
That's a fair point. Absolutely. Sure thing. So, Leith, we'll jump across onto the Australian workers. So, not sharing in the otherwise the gains of the nation. Is that?
Yeah. Look,
purpose of this slide?
If I could ask you to take away any particular chart out of this entire pack and this entire talk, it's probably this one. And what it shows is, I've got a chart here plotting real average compensation per employee, which comes from the national accounts. So basically got the data from the national accounts deflated by inflation. And I've compared it against labour productivity, i.e. GDP per hour worked. And what it shows is that in the past 6 years, that is since March 2012, real average compensation per employee has fallen by 3.8%. So again, workers are going backwards. And this is despite, reasonable growth in labour productivity. So over the same period, labour productivity has improved, quite substantially, although it has slowed down recently. But at the same time as labour productivity has been improving, real wages have been falling. And this is part of the reason why, we have this, all this controversy over wage growth, etc. And, a lot of people don't feel like they're benefiting from the so-called economic boom that we're going under, that they were under, or the so-called strong jobs and growth. And this is really the crux of the issue. Again,
Sure.
The average person's going backwards, and this is part of the lost decade meme that we've been running for quite a long time. And more evidence of this comes to light with the next chart, where I've plotted the Australian household savings rate, which again comes from the national accounts, which has been falling for several years, and for about 5 years, and it's actually hit the lowest level in the post-GFC period. So in the March quarter, the savings rate fell to just 2.1%, which again is the lowest in the post-GFC period. And what this means is that in order to maintain the level of consumption, households are effectively drawing down their savings.
Sure.
And that rate includes compulsory super
That's right.
as well, doesn't it? So X your compulsory super.
It's negative.
We're probably negative, yeah.
Yeah, I've never actually tried to adjust that, but just because we know the compulsory super rates, annuation rates are 9%, but we don't actually know what it truly is across the economy because not everyone pays super or whatever.
And people coming out of
That's
super
right.
as well and things, yeah.
Yeah.
But it's probably negative.
Yeah, that's right. So if the savings rate's 2.1%, the compulsory superannuation rate's 9.5%. You can pretty much guarantee that's negative at the moment.
Wow. Yep.
Which means that households are basically drawing down their savings in order to keep their consumption at the same level, which is clearly unsustainable. And this is also shown in the next chart, which everyone's seen. We all know it. Australia's household debt to disposable income is at the highest ever level. It's about 190%, second highest in the world, according to the Bank for International Settlements. And again, this is more proof that that households are drawing down the savings they're borrowing to maintain the constant level of consumption. And this is important because consumption accounts for about 56% of final demand. So it is the key driver of growth in the economy, spending in the economy. So I guess consumption's holding up okay, but it's only holding up because households are borrowing and drawing down the savings, which isn't sustainable in the long run.
And because we're getting more households.
That's right. Yes. Yeah, of course. Yeah. More households. I'm talking, I guess, a per capita sense, but yeah, there's more people being added, which is doing it, and also everyone is in aggregate drawing down the savings and borrowing more.
Yeah. I might duck in really quickly just on the investment side because it's interesting. You can take two views from this data. One is you say, well, gee, isn't it unfair that businesses are capturing all this benefit and then consumers are copying it? And then from the investment side, you say, well, isn't it good that businesses are capturing all this and they're not having to give it back to those sort of lousy employees? the issue is at what stage does that reverse? So from an investment perspective, yes, you like to be in companies and generally invested in economies where the share of business profits is growing as a percentage of the percentage of the economy, and you want to be. So if I'm talking about investing in Australia or investing internationally, if you're looking at a country where you're growing, you at face value, you'd like to have more of that country.
Sure.
The issue, though, is how far you can pull the elastic band before it snaps back, and you start getting the you either get the wage inflation or you get the the issue about popular discontent that sees the rise of populist parties. And I think my take on economies in the longer term is that yes, people are do irrational things in the short term, but they eventually work things out. Like they might not know the detail of it, but they do. You get the rise of these populist parties like the Trumps and the parties we're seeing in Italy and other places, because if politicians spend all this time telling them, hey, Leith, you've never had it go so good, look at this great GDP growth that's happening and all that type of stuff, and you're sitting looking at your pay packet going, well, I haven't had a pay rise for 5 or 6 years, and everyone I know is going backwards. It grates on people being told that things that you've never had it so good, and you're going backwards, and that's where you get these populist changes, and then you can then you get big shake-ups to economies. So
do you feel that Australia's right for a populist change?
I think we're a while away yet from that. I guess certainly from one of the populist changes, but I think there's certainly discontent brewing. The question is, do we have a viable option that people would flock to? I think the rise of One Nation shows that there's discontent. I think that being a viable option, they're a long way away from being a viable option. But so I think from an investment perspective, you need to sort of dissociate and say, well, things are still ticking along, and things we are still seeing growth in this, and the way we're set up is that all these trends look like they're going to continue. We'll jump into some of those trends that, in the next few slides.
Yeah, sure.
But I think it's just worth noting that as we're looking through this from an investment perspective, this is what we're considering: is has the elastic band stretched too far, or is there still scope for these trends to continue and businesses to still keep making out at the expense of consumers?
Okay, yeah, sure. Thanks, Damien. Well, look, before we jump fully into the investment piece, we'll maybe just throw a capstone on our webinar today with some future headwinds. Leith, I think you had a few things to talk about in regards to what we should be focusing on in the future, given the fairly dire set of circumstances you've illustrated for us today.
Yeah, well, I mean, it's not dire. It's just, I guess, subdued.
Subdued.
For the ordinary person, I guess, is the best way to look at it. What I've done here is we've put back up the real final demand chart, which again is the domestic economy. There it is. There, it's the same chart from before, and this kind of shows the contributors to growth along 4 key segments. And we know that dwelling construction is going to fall in the period ahead. This is pretty obvious with all the construction data that's coming out, the dwelling approvals, etc. So we're expecting dwelling construction to continue, housing investment to continue to subtract from growth going forward.
And actually, having said that, though, if we could continue with a particularly high population growth, which seems to be that both major parties seem to be still headed down that path, I guess what I'm wondering is, it doesn't seem as if it can really drop away that far. Like, I mean, I guess that's where there's probably been a build in the recent years that's been appropriate for the level of people that's coming in. Maybe a little bit of an overbuild as a catch up. But if we're going to keep pouring people into places, it's hard for me to see how far that could fall without a financial shock. If we don't have a financial shock,
Can I answer that one for you?
Fire away, Dave.
Well, we're in a financial shock.
Yep.
Coming out of the Royal Commission.
And house prices are falling.
House prices were already falling, and now we've got considerable lending standards tightening. And it's a simple fact that when house prices fall, dwelling construction falls with it. People get spooked. They don't want to invest. At that point, credit usually gets tighter for developers as well. you know, these things don't necessarily have to turn into a disaster, and you know, kind of form feedback loops with bad debt and what have you. But post Royal Commission, if lending standards are structurally tighter, then there will be an adjustment over a reasonable period where you'll have a step down in both house prices and dwelling construction, regardless of population growth. Now that could rebound after that reset, where you know people can just get less credit, even though there's more of them. It could start growing again at the rate of income, but we've got to go through the reset first, and then you've got to ask yourself, is that reset going to then be hit by other cyclical factors that might make it worse again before it can get better?
I can also just say the Housing Industry Association released their dwelling starts forecasts only about a week ago, and they actually themselves forecast that housing starts, so housing commencements are going to fall by 17% in the next 3 years. So even the HIA who is forecasting a downturn. Also, as we know that demand is fungible, or can swing quite wildly, and obviously if people can live at home for longer, they can share with friends. So if there is a downturn, there's always the possibility that we actually end up with an oversupply of housing in spite of high population growth. Now, I'm not saying that'll happen, but I think we can bake in dwelling construction subtracting from growth. How much, we don't know, but I don't think it's going to be a support the next few years. It's, if anything, it's going to be a bit of a dead weight.
And I guess where I'm leading to with this is that we spend a lot of time talking scenarios and the upside downside type scenarios, and I think we're all relatively well versed, I think, in the downside scenario, which is you get this credit start to freeze up, house prices start to fall, that sort of leads to a little bit more house price falling, and if we get any external shocks, then we could really be in trouble. I guess if you took the view that everything will work out and you get a bunch more stimulus thrown at this, I guess what I'm positing is there a scenario, if we end up with a scenario where we start to hit a few problems, the government throws some first home buyer grants at it, they bring in some more people, there's a bit of stimulus here, maybe we'll let people dip into their super or do whatever it is let's do whatever we can if the government takes a view, let's do whatever we can to prop the housing market up. Could this just be could this be the, rather than being the sort of the final hurrah, could this is a bit of a downtrend before we get the final big blow off, because we don't get the construction spending and off we go again.
Well, my personal view is that they will definitely do that for starters. They always have before, and in the contemporary Australian economy, private debt is everything. So they'll definitely try to boost it and prop it up. But we already have generous first home buyer grants in the market in Sydney and Melbourne, which are
not doing much.
Well, prices are still falling. They're certainly helping keep the bottom end supported. Yeah. And so they're diminishing the rate of fall. That said, you never know, they can always boost them further, and we can get into ludicrous kind of stimulus levels. I mean, I think you can expect that if things really turn pear-shaped. But at the end of the day, if it's become illegal to extend credit in the way that we used to, with very high multiples, very poor assessment of income and expenses, which is what is transpiring in the Royal Commission. We don't know the final outcome of it yet, but in effect, that it's declared loose lending illegal, and what the wash up will be in terms of hard constraints on that, we don't know, but we do know it's going to be much harder than it used to be. Despite that stimulus, your flow-on impacts are going to be much diminished than they used to be. I mean, if you look at the history of lending that came out of the various stimulus episodes for housing in the GFC, and then again in 2011, when the mining investment cliff formed and they needed something to pump the economy over it, they got progressively more extreme in terms of loosening lending standards. In the GFC boom, they force-fed all sorts of stimulus into banks and demand, and on the supply side as well to loosen things up. The government bought lots of RMBS. The RBA did all sorts of things to try and loosen credit as well, on the supply side as well as the demand side. Then during 2011 we had, what was really extraordinarily reckless interest-only boom based around investors, which is just plain subprime lending, which is now also resetting with some sort of refinancing cliff associated with it. And so you needed to get progressively more reckless each time to keep the thing afloat. And if you've got now some kind of hard cap on how reckless you can be, then those stimulus measures simply are not going to work as well as they used to.
And remember also the state governments have all brought in, basically stamp duty taxes on foreign buyers as well, which has, supposedly impacted quite negatively foreign demand, and including on new homes. So that's another thing that's subtracting on dwelling construction. There's a whole bunch of things that could happen, but I guess the base case at the moment, and you look at this, and you can, the key thing that I look at is dwelling approvals, and dwelling approvals have definitely come off. They're off about 8% from peak. They're not falling off a cliff. They've actually rebounded a little bit, but if you look at dwelling approvals, they're all pointing to lower dwelling construction. And dwelling approvals tend to be about 18 months to 2 years forward looking, because a lot of that's apartments and they take a long time to get off the ground. So
as a base case, you can say it's going to fall for a few years at least.
That's right.
Yeah, but I guess
certainly not off a cliff.
Yeah, and that's where I'm trying to get to, is for valuing, say, the developers and people involved in that area of the market is trying to work out, well, if it's a cliff coming, then let's wait till we've hit the bottom, and then let's try and pick up the pieces and work it out from there. But if it's a bit of a if it's a bit of a dip, and maybe it's a lot of the small guys getting pushed out by funding issues and all that, and so maybe some of the bigger guys can actually. It's an advantage if net approval is going to fall by 20 or 30%, say, but it's going to wipe out all the small guys, and so the big guys are actually going to be developing about the same as what they're developing now, or a little bit less. Then maybe there's more of an investment argument for trying to pick the bottom in those ones than if you're worried about the whole thing falling apart, and then it's going, okay, well, if the whole thing's going to fall apart, let's just stay away and not get involved.
Yeah, well, I mean, at the moment, I'd say there'll be a moderate downturn lasting for several years. And look, if you look at the chart, you can see at the moment dwellings investment starting to subtract, not by a lot, but I suspect it gets a little bit worse. And it will subtract, but it just, at this stage, doesn't look like it's going to be a huge subtraction. But if I was to say the risks are anywhere, I'd say they're on the downside. Purely because prices, the Royal Commission prices are falling. Foreign buyers are deserting. Also lot prices. So lot prices in outer Sydney, outer Melbourne, in the high-rise space are insane at the moment. The cost of land is just so expensive that it probably will drive a few developers to the wall.
Yeah, and a lot of developers, a lot of the listed developers have 15 to 20 years of land locked up, the next 15 to 20 years worth of supply ready to go. And so in a way, when you buy them, you're buying a third to 2/3 of a developer, and the rest of it's a land bank. And that's been a fantastic investment for the last 20 odd years. But yeah, that's obviously the other issue you have when you're investing these. And my take on looking at developers as an investment one is that if you're playing it as this will all. It's a little bit the way we were talking about the banks a few weeks ago, is if you're playing this as, hey, it'll be a bit of a minor downturn, this will wash a lot of the small guys out, but everything will come good, and there'll be so much stimulus and everything thrown at it that'll never go terrible, then you can make an argument for buying them. But I think it's the same issue as to why we're underweight the banks and been winding back on the banks as well, is that there's you get the wrong push at the wrong time, and it doesn't matter how much stimulus you're going to be throwing it. As David said, if you're cutting back on, if you can't loosen up on credit standards from a legal perspective, and is that the government just won't be fast enough if you fall. So there's a negative scenario where you lose a lot of money that sort of overwhelms maybe the base case, which is a bit of a downturn and not too bad on the profit side.
Sure.
Can I just say, so I guess the base case, dwelling construction is going to fall and drag a little bit from growth, but on the other hand, business investment, after falling for about 5 years, so we bring that chart up again, after falling for about 5 or 6 years after the mining investment boom, it's now starting to add to growth. And that'll probably offset the dwelling construction fall looking forward. The most recent CapEx survey is pretty weak, so we're not expecting a big bounce in business investment, but it should at least add moderately to growth the next couple of years.
Can I just say as well that a very large component of that business investment is actually property as well, commercial property, and some of the markets around the country for commercial property are okay, Sydney and Melbourne offices, but there are actually big headwinds building for large segments of that component as well, like retail especially is under a lot of pressure, which means mall owners and REITs, etc., are going to be facing quite an uphill battle to develop any new property. And then there's the apartment segment as well. So I wouldn't be surprised if that business investment offset is also very capped.
In terms of the government side, we hit the financial crisis, and there was a lot of talk about needing to have shovel-ready infrastructure so that we didn't have to waste money on pink bats just to get people out doing stuff. It doesn't seem to me as if we do have a lot of shovel-ready infrastructure ready to go. Is that?
Well, yeah. I mean, certainly actually, I might segue that into the next one if that's right. Sorry, in the same chart, but in the next point. I guess where the rubber hits the road on final demand in the next few years is going to be two things. It's going to be public investment. So you can see there that public investment's risen public demand's risen quite significantly in the last couple of years. Now that's both investment spending as well as other consumption spending by government, and a lot of that relates to obviously the infrastructure build out that we're seeing in places like Sydney and Melbourne, and also things like the NDIS. So the public demand is supporting growth quite a lot at the moment, and this is I guess gets down to the Botox boom that the term Dave coined, which is
well, I mean, it's just the whole idea of the Botox boom was largely what Leith was describing earlier, which is a boom that looks good on the surface, very sexy thing for politicians to pout about, but underneath, is actually sagging and crap for everybody who's in it.
Profitless.
It's a profitless boom. In terms of government spending and the infrastructure pipeline, the key point for everyone to take away, and this is something that the Treasurer doesn't seem to understand either after celebrating all of these booms this morning, and celebrating utes as the way forward to prosperity.
The ute index.
The ute index. That is that when it comes to all of these kind of business investment, dwelling investment and infrastructure, it's all about rate of change rather than the amount of investment. And we have had this huge kind of surge of infrastructure building, and that has contributed to growth on the way up. But there's a little bit more climb to go over the next 12 months, but at that point you're at a very high plateau of investment dollars, and projects also roll off as you go forward, and to replenish that pipeline you've got to have continually more aggressive investment. So it doesn't, in effect, once you reach the peak, it stops contributing to growth unless you're investing more than you did the year before. And so these booms are one-offs, and they run out of growth steam really quickly. And so the government spending side of what's been contributing to growth is running out of petrol quite fast.
Yeah, but I guess that's where I'm leading with my question, though, is saying, okay, there's obviously popular discontent certainly rising everywhere about the amount of population growth and inadequate infrastructure for the population growth. Is that if both parties decide to take the line, well, we're going to keep the population growth because it juices our top line stats, as we've seen. But you know what? We're going to throw a lot more money at infrastructure. I guess where I'm trying to work out is if that was turned around and that's the policy that both parties start to chase, is that do we have the infrastructure shovel ready projects ready to go is one question, and it doesn't sound like we really
no,
do.
and in fact the Turnbull government's classic in the budget they said they got $75 billion of infrastructure investment over the next 10 years. Well, that's $75 billion over 10 years. That's
Nothing.
That's chicken feed.
One oil plant, one oil and gas plant on the
it's
on the
basically it's one and a half what LNG plants over 10 years, I guess.
Well, it's less than one if you're talking Dorgon. But
there you go. Yeah. So I guess they don't. But the other thing is also a lot of the spending has been related to the NDIS, which is probably another year's rollout. And I know this because I'm going through it at the moment with my son. And there's the amount of middlemen and whatever you got to deal with. There is a lot of spending going on in the economy to roll this thing out, and that's there's been estimates that's already added 100,000 to jobs, and it's going to add another 100,000 in the next year or so. So again, once that peaks, once you hit the peak, then you start getting the subtraction from growth.
Yeah. I think Damien's your point's right. They're going to keep throwing money at it. Absolutely. The point is, can they throw enough?
Yeah.
Because you already have a serious boom, largely from state governments, spending like mad on this infrastructure. One of the major problems they face is the NBN, because it's been running for so long now, and it's such a big capital investment itself. It peaks this year and starts to run off.
Right.
And so to replenish that pipeline, it becomes harder and harder as the NBN is completed. And all of the employees from the NBN roll off and need something to do. So they'll keep doing it, absolutely, but for it to keep contributing to growth,
it's got to grow year on year,
is very difficult for them to achieve.
And
there's also something that Leith touched on there, which is the constraint in the budget, which is political and economic at the federal level, where both Labor and the coalition basically measure their economic success on whether or not they're getting back to surplus. And so that's a hard constraint on what they can do federally.
Fiscal straitjacket.
Yeah, and as house prices fall or plateau or diminish and dwelling construction gets hit, then state government's budgets come under a lot of pressure as well, because they're very stamp duty reliant. So far, what they've done is roll their housing booms into into infrastructure booms via stamp duties.
Yes.
And as they start going backwards, it gets harder as well.
Yeah.
It's the same with federal government and commodity prices.
Yeah. Because that's one area I was sort of contemplating doing a little bit more work from an investment perspective is the, now we're talking about our Ute index, as that's come out, is that when you're building the NBN, not only do you have that same problem, there's lots of middlemen between, somebody takes a contract who offsets it to somebody else and whatever, and the last guy, the subby on the end of it might be 3 or 4 levels deep, but he generally does own a ute, and he's out there digging trenches to stick in the NBN. When you need to build a new tunnel for roads or for rail transport, that guy probably can't be using his ute as part of that whole build concept. And when you do a big tunnelling project, yes, they're very, very, very expensive, but a lot of that is capital cost, and that's going to generally international owners of drilling equipment and that type of thing, and you just don't have as many people. We haven't got 100,000 people with picks and shovels digging out these things, digging out the tunnels under the roads, whereas
you've got one big machine, driven by a dude.
Exactly, or a lady.
Well, and I didn't mean that as a gendered thing.
And whereas you do actually, for the NBN, you do actually have a bunch of guys out there with picks and shovels and things like that, because that's what they need to do. They need to dig up the footpath to put in these things, and so I guess what I'm trying to work out is, we know that, I'm pretty sure there's an infrastructure boom coming, and as I said, as all these things fall off, there'll be more money thrown at it, but it's trying to work out what are the projects, and are they actually projects that are going to benefit. And so, you spoke about the disability scheme. It's hard for me to work out. There's some health people who can benefit from it, but a lot of it is more about, there's more. It's good for nurses and for occupational therapists and for speech therapists and things like that. But a lot of it's just training people up, and there's a big employment thing there. But they are quite lowly paid jobs. People who are doing those aren't doing it because they want to be multimillionaires. They're doing it because they want to help people. And so there's a positive there. But if there's a negative from the NBN rolling off and losing that and the money being spent on capital equipment, what are our other big projects that are being done? And is the employment happening here, or is it happening in France or in somewhere else where they're making all this stuff, in China?
Well, that's the $1 million question. I mean, it's Australia's just had, I guess, 3 types of booms and mini booms. We've had the mining boom, which we all know about. Then after that rolled off, we then had the housing boom, so both prices and construction. That's now rolling off, and now we've got the Botox boom, which is basically government-led spending in things like infrastructure and NDIS, etc. And that's got probably another year to run before it peaks. What comes next? The 3 things I've already mentioned count for about 45% of final demand. So that's dwelling construction, business investment, and public spending. We know that business investment and dwelling construction are probably going to offset each other. We know that public spending's contribution to growth is probably going to peak next year and then start falling. So that leaves us with the last big one, which is...
I'm going to push back on that one, though. It does look like that from the numbers, but I guess if things start to look worse, that's what I'm trying to lead is I think they can still throw more money at that problem. Our government debt levels are low. There's a general populace. If people start running platforms about we build all these new train lines, we're going to do all this new stuff there's votes in that. Yeah,
there is, but there are, as again, the federal government's going to be fiscally constrained because we've got falling house prices that's going to destroy the states, and we've got at the same time, there's every likelihood the commodity price mini boom that we've had is going to roll off as well. So I mean, look, it could potentially happen, and there's potential that it mightn't subtract from growth going forward, but it's going to be pretty hard to add to growth from this level.
Yeah, and is there a hole? And that's where I'm trying to work out.
Oh,
if there's a hole of a year or 2 years while you get all these things just going, we're not shovel ready, and so you turn up and say, okay, it's not 75 billion over 10 years, now it's 75 billion it's another 75 billion over 3 years, but nobody can actually spend it for another year and a half because nobody's done the planning and nobody's done any of this stuff. Then you say, well, now we've got a whole. Not only have you got a number of these problems and nothing to fill it, but
I think the projects are rolling out. I don't see a hole, but it's just a very big pipeline that will be very difficult to sustain. It's a lot of money. To keep coming out every year.
It's the same problem.
No, hang on. Let me finish. So in terms of investment, the government is going to struggle to generate growth. Where they'll continue to contribute to growth is in recurrent spending. So,
but again, that doesn't add every year.
No, but they'll just run. They will if these things start to actually weigh on growth. And unemployment keeps rising, then you get the automatic stabilisers kicking in, and the deficit will grow again, and recurrent spending will rise, and so there'll still be support from the government side, but it won't be productive investment. It will be government spending just to keep things afloat.
But I think. And certainly, but in terms of productive investment, it comes a bit back to you're digging you're burying bottles and bringing them up, and so the question is it? I guess that's where I'm trying to work out how fast can the government spend the money. If things go wrong, can they step in? Because I think that, as Leith said, we've been through our 2 booms. That the only thing I can really see that can save us is a lower dollar, which would then stimulate actual business investment in Australia, and so but considerably lower still from where we are at the moment, or a government. The 2 things we've got is that and a government boom. We've got relatively low levels of government debt. We could have this massive spend, and maybe we will.
Would you say that that's probably where we're headed, though? Like we're kind of in infrastructure boom period at the moment. And then it's going to roll into perhaps an infrastructure Ponzi situation where you've just got to goose numbers to through debt.
There aren't. I mean, look, there are a lot of projects that Infrastructure Australia wants to do, and there's a list out there to do them. But as discussed, there are a number of fiscal constraints that, there's a reason especially why the federal government has not launched a much larger infrastructure push. It's not what they want to do or see where their political success lies in the longer term. And yes, we are in the middle of an infrastructure boom. It's already happening. The question is how long can you keep it contributing to growth? It's the rate of change that matters. And it's, if you look at the pipeline, there's like 20 or 30 major infrastructure transport infrastructure projects going, most of them across the East Coast. They can keep adding to them, but as the NBN monster rolls off, which is like a $50 billion beast, they have to add a huge number of projects just to keep the level unchanged.
Yeah, basically for every project that falls off, you got to add another one of equal size just to keep growth.
Just to not shrink.
Just have zero growth.
Yeah.
Yep.
And so that's the problem.
Yeah, that's the problem, and that they're going to really struggle to do that. Like,
it doesn't mean it won't still be at a high level. It just, but it won't.
That's right. And there are a lot of shovel-ready projects underway. Like, the building's happening. They came in later than they should because, as the mining investment cliff kind of took them by surprise. Everyone expected the mining boom to go for 30 years instead of 3, etc., etc. And so they filled that gap with a housing bubble.
Yep.
And now they've got fiscal.
They were filling it with some infrastructure.
Now we're filling it with some infrastructure, but it's just the nature of the beast that it's very difficult to sustain the spending at that level unless you're China. You've got to be able to have just centralised control where you just say, right, we're just going to build a city there, and we'll build a high-speed rail network, from Timbuktu to Cape Town. So, but Australia's so broken in terms of its processes that keeping this level of spending up is going to be extremely difficult.
Yeah, and look, ultimately the outlook for final demand is going to hinge primarily on consumption. Consumption's the biggest driver. It's 56% of demand, and we see consumption as being constrained simply for the fact that we've got extremely weak wages growth. In fact, wages are going backwards, as we showed earlier, in real terms. And we've got extremely high household debt, falling savings rates, and also falling housing prices. So those factors aren't conducive to strong household consumption. And if household consumption weakens like we think it will, that's going to obviously weaken growth and demand. So I guess the upshot of all this is that I think Dave would agree that we see pretty weak household final demand. Australian final demand in the next few years, and an ongoing situation whereby the aggregate growth's soft, but the per capita growth's terrible.
And I guess that sort of leads us a little bit into looking outside of perhaps obviously there's the housing market, banks, everything's been quite credit constrained, or that's the viewpoint going forward. But in terms of impacts for investment, Damien, elsewhere, I guess in the Australian stock and share and company landscape.
Yeah, let's take a step back first, because I think the main thing from an investment point of view is, and the story we've been pitching for a number of years now, is that as these booms don't have something to. We don't have a next. The next is a much lower Aussie dollar. Is what needs, and that's where I'm sort of asking these questions about, can we get another bit of a, can we push out for another year or another 2 years of government spending? And I think we probably can, but as David said, it doesn't look likely. It doesn't look like the base case at the moment that's what that's what's going to happen, because our biggest call is, do we buy Aussie or do we buy international? And that's where nothing we've been speaking about today sort of changes that view that, look, times are tough for Australia. I personally think it is, the government has low enough debt, we could throw enough things at it to get another boom going somewhere, whether it's infrastructure or other bits. But I don't think there is a political will, and you need a long time to build that up, and so there is that hole. And so the thing we need is a lower Aussie dollar, which means international. You want to be investing internationally rather than within Australia.
Okay.
So I think that's the core thing, is there's nothing changing, and we've sort of been through these accounts, and the discussion we're having, the discussion from me is about saying, is there anything changing that view? And I can't see anything changing that view, and it is a political thing that would change our view, I think, in terms of a big infrastructure boom, a bigger infrastructure boom coming, and willingness to do it, and that doesn't look likely.
Yeah, look, I personally believe that the quarter we've had is probably about as good as it gets for the Australian economy for the time being. Just for all these factors. So yeah.
Your best bet is I guess, positive outcome is probably a big spending in China, which we don't think is likely as well. But if that happened, then there's another leg up for the Australian economy. But that's not in our base case at the moment.
But even that would be, that'd be a different scenario. Like you've already got, the rivers of gold, as Chris Richardson calls them, going into the fiscal coffers, such that we're almost running budget surpluses now. If China were to stimulate again and you get more of that, for the reasons we've already discussed, you're not necessarily going to see more government spending, but you would probably see more tax cuts.
Yeah, that's right.
And so they'd aim for supporting private sector demand, basically.
Yeah, we get the debt a bit higher.
Yeah, we can get the debt a bit higher. Our favourite trick is to make structural budget tax cuts on the basis of cyclical revenue bounces. So
that's right. And the thing is, if you can, you basically take a wage rise and leverage it up, well, at least 5 times, probably 10 times, I guess, in the old days. I suppose if you're talking about a 90% deposit versus an 80% deposit, so if you've got an extra $10 of income, then you can turn that into a significant larger loan.
That assumes that the credit's freely available, though, and that's certainly getting harder.
Yeah. And that's like probably the key broken mechanism now in terms of the way the Australian economy used to work, which was sell dirt to the world for income, then borrow money from the world to leverage that income up. And we're really struggling on the leverage leg now, for a number of different reasons. Some because of the Royal Commission, and household debt is so high, and scepticism therefore about the bank's stability and financial system, but also because the population growth needed to support asset prices is tearing the political economy to pieces as well. And so that second step in the great Australian business model is increasingly troubled.
Yeah, and look, the question on those, though, to push back on that a little bit, is saying I don't disagree. There's a rising stage of discontent and possibly macro businesses towards the vanguard of that movement. But
we try.
But neither major political party has come out and expressed a desire to significantly cut the rates.
But my point isn't that it would necessarily be cut. It's that the model of growth that it engenders can't be leveraged.
Yeah.
Because there's no income growth.
Yeah.
Because you're splitting existing income between more and more people. And so you simply don't get the boost to the underlying income to leverage either.
No, but
it's also be very hard for them to actually raise immigration from current levels that are already extremely turbocharged. So again, it's this whole thing. If you're not increasing it every year, you're not adding to growth. So sure, they can maintain it, but that's just going to keep everything at zero, other things equal.
Yeah, because the biggest issue for me is, does it all fall apart at some stage? And I like to think that it probably will, but I can't see that happening in the very short term, and it might be a few years yet before. And so, from an investment perspective, it is a matter of the timing to say, when you can see the trends happening and you're positioning your portfolio for these longer term trends, but there's no sense in being positioned for the whole thing falling apart if it's not going to fall apart for another 2 or 3 years.
Yeah, look, it may not fall apart all by itself.
You don't need an outside
external shock.
Yeah, but on that front, we can see China slowing. So the income that underpins the leveraging in Australia is also likely to start falling away. So
yes,
next year you will see greater headwinds, and probably in the second half, greater headwinds on both steps in the Australian business model.
Houses and holes.
Houses and holes. There'll be less income from the holes, and there'll be less leveraging for the houses.
Yep.
And so that doesn't mean it's a catastrophe, but it means it's a very profit-constrained economy. And if you're talking about investment,
When I said profit,
It's a lost decade.
it's a wage, and it's probably more wage constrained. I mean, profits. There are issues with profits and sustainability of profits, but I think it's probably to me it's a wage growth constrained, which then means
it's
you need to
also
make-
profits
Yeah.
constrained. If you look at that profits chart,
Yeah, it tracks very closely with the terms of trade.
it does.
Yeah.
The huge bounce we've got right now is all mining.
Yep.
Oh, absolutely. Absolutely.
And when that goes away, which is what we're talking about here with falling bulk commodity prices,
Yeah.
you may well see a downtrend resume in corporate profits as well as wages.
Yeah, although wages have basically experienced no bounce since we've had this mini commodity price boom. It's all gone to profits, and if commodity prices reverse, obviously profits will fall. Wages might just keep tracking, going nowhere like they have been.
Yeah.
But either way, it's not great.
And I guess...
Well, it's not great investment,
No.
is the point. There's just,
Yeah.
too much of your activity is just empty calories.
Yeah.
There's no productivity gains, there's no release of income, there's no, increased productive capacity. There's none of the things that create profits and profits growth are present. You're digging holes and filling them in.
Fantastic. All right, well, on that note, wonderful finish there for an extended session, extended webinar with the Brains Trust behind the Nucleus Wealth Investment Team. I'd like to thank you, gents, for coming in and sharing with us your thoughts on the national accounts and where the direction, or the direction that we think the investment landscape and also Australia are headed. So thanks very much, guys.
Cheers.
Thank you.
Cheers. And on that note, I'll just jump across and we'll hear a little bit more about Nucleus Wealth. So Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation, as you've heard today. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We do this by using separately managed accounts, which allow clients to enjoy unparalleled transparency on what they own and why. It also means that each client effectively owns their own and separate and discrete share portfolio managed by us. We've partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and also JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel this structure is the gold standard for your financial protection. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them time to explore areas that they may be of interest to them or they've got experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863, or you can contact us through www.nucleuswealth.com. Jumping from here, we've got next week, of course, we're going to be looking or continuing on our Quant Rocks series, and this time we'll be having a look at the quality aspects of how we engage or how we review stocks on a quality basis for inclusion in our portfolios. Same bat time, same bat channel, Thursday the 14th of June at 12:30 p.m. Australian Eastern Standard Time. And if you're interested in coming along to that one, feel free to book or register your interest at proton.nucleuswealth.com so we can keep you abreast of any updates and also, of course, send through the feedback seminar, the questionnaire rather, at the end. Also, we're as always, we're available on iTunes and wherever you get your favourite podcasts from on Android. So Podcast Addict was one that jumps to mind. And just finally, of course, as always, we'll be sending around our questionnaire to give us a little bit of an idea from yourself on how we've gone today, any information or anything you'd like to pass through, and of course, any further topics you'd like us to research and bring to you. So on that note, I thank you very much for your attendance. I hope you got something out of our extended expose on the national accounts of Australia as it up to March this year, and we look forward to catching you at the next one. Cheers.